What if I told you Microsoft might be mispriced? We're about to find out using rigorous cash flow analysis of Microsoft. Will the market's valuation hold up? Let's see. Now let's understand what Microsoft actually does. Microsoft develops, licenses, and supports software, services, devices, and solutions worldwide. The company operates in 3 segments: productivity and business processes, intelligent cloud, and more personal computing. They're a technology company with a $3.5 trillion market cap. With this business context, let's see what the valuation analysis reveals. Here's where it gets interesting. The market is pricing Microsoft at $476.12, but our DCF model suggests it's actually worth $392.41. That's a 17.6% gap, and here's why this matters. Here's how we're modeling the growth. We're using a weighted regression of historical and Wall Street analyst consensus estimates, which incorporates forward-looking growth expectations from professional researchers. We're assuming 15.4% growth initially for 5 years, then tapering down to 4% over 10 years total. We're also projecting an EBITDA margin of 52.4% based on historical operating efficiency. The discount rate tells us how risky this investment is. Using Professor Damodaran's data, we get a cost of equity of 8.8% and cost of debt of 3.3% after taxes. This gives us a weighted average cost of capital of 8.8%. Now let's see how these assumptions translate into cash flows. We start with high growth of 15.4% for 5 years, then taper down over 5 years to our 4% terminal rate. This creates a realistic growth trajectory that captures the company's maturity cycle. Here's where it all comes together. Our DCF model gives us an enterprise value of $3 trillion. The terminal value represents 67.5% of this total. After adjusting $30.4 billion in net debt, we get $2.9 trillion in equity value, which translates to $392.41 per share. The model assumes 4% terminal growth with 8.8% discount rate. The DCF model gives us $392.41, but what if our assumptions are off? The 15.4% growth rate and 8.8% discount rate drive this valuation. Explore different scenarios at Stockoscope.com to see how sensitive our model is to these key inputs. From growth assumptions to final valuation, we've built a DCF model for Microsoft. The beauty of DCF is that you can apply this same methodology to any stock. Check out Stockoscope.com to analyze other companies and refine your valuation skills. Subscribe for daily stock analyses and like this video to support educational content.